Okay, so let's get right into it. December 5th, 2025. What a fascinating day for the global economy. Seriously, it was like a giant, complicated puzzle. And one single piece of data, one that everyone had been waiting for, finally clicked into place. The moment it did, it just unleashed this massive wave of reactions across the markets. Some were fantastic, but others, well, they started telling a much more complicated story.
So, here's the game plan for how we're going to unpack all this. We're going to start with that one report that really shook the markets. Then, we'll jump over to a massive corporate deal that happened. After that, we'll dig into this weird split we saw in the stock market and some totally contradictory moves in currencies and crypto. And then at the end, we're going to pull it all together and figure out what it actually means for you.
You know, pretty much everything that went down on this day can be traced back to one single thing: the release of a really critical economic report. It had been held up for weeks because of a government shutdown, and when it finally landed, it was like a bombshell. It was the catalyst for literally everything else that followed.
So the huge question that was on everybody's mind was pretty simple. What was it going to take? What one number, what specific piece of data would finally convince Wall Street that yes, a rate cut was definitely coming? Well, the answer, as it so often does, came down to inflation. Now, the specific report everyone was obsessed with was the PCE price index. You hear about inflation all the time, right? But this isn't just any old number. This is the Federal Reserve's favorite metric. It's the one they look at the closest when they're deciding what to do with interest rates. And that's why Wall Street was watching it like a hawk. And here are the numbers. The one that really lit a fire under the market is right there highlighted, the core PCE. Now that one strips out the crazy food and energy prices. It only rose by 0.2% for the month. That was the tame number everyone wanted to see. But, and this is a really important but, look at that last line. Real personal consumption, what people are actually spending after you account for inflation, was totally flat, 0. It kind of suggests that consumers were really just treading water.
And the reaction to that one tame inflation number was just immediate and frankly dramatic. All of a sudden, the market was pricing in an 87% chance of a Fed rate cut at their very next meeting. To put that in perspective, just 2 weeks before, those odds were sitting at only 30%. That is a gigantic shift in thinking. But all this optimism around interest rates wasn't the only major story of the day. Nope. At the same time, we got another massive headline, this time from the corporate world. A deal so big it's literally reshaping the entire entertainment industry.
I mean, just look at this number. $83 billion. That was the price tag on Netflix's deal to buy Warner Bros. Discovery. A deal this big doesn't just make waves, it's a tsunami that completely changes the whole landscape.
And you gotta understand, this wasn't just some simple purchase. This really represents a key battle in this ongoing war between the old guard of media and the new titans of streaming. We're in the middle of a full-blown arms race for content, and a deal of this size just shows you how incredibly high the stakes have gotten. And believe me, this isn't just happening in media. The Netflix deal is really just one symptom of a much wider trend, this tech-driven M&A supercycle. In fact, U.S. deal-making is up a whopping 45% year over year. Why? Because companies in every single industry are scrambling to buy the technology, the data, and the digital reach they need just to survive. Okay, so rate cuts are coming, big deals are happening, everything sounds great, right? Well, this is where the story gets really complicated. Because all that optimism, it wasn't shared equally across the stock market. Not even close. It was actually a tale of two completely different markets. And you can see that contrast, clear as day, right here in the year-to-date performance. The tech-heavy NASDAQ, up over 22%. But then you look at the Russell 2000, which is the best way to track smaller companies, and it's lagging way behind. The big guys are absolutely soaring, while the little guys are just struggling to keep their heads above water. This split is what a lot of analysts were calling a critical yellow flag. What it tells us is that even with rate cuts supposedly right around the corner, big investors are still really worried about the health of smaller companies, the ones that have more debt. It's a huge warning sign that there might be some serious credit risk hiding just beneath the surface of this big, flashy rally. And that wasn't even the only strange thing going on. The weirdness actually spread beyond stocks and into other major assets. Both the US dollar and cryptocurrencies started sending some really confusing and, frankly, contradictory signals. So check out this puzzle. Both the dollar and crypto were falling, but they were falling for completely opposite reasons. The dollar was dropping because the promise of rate cuts makes it a less attractive currency.
That's a classic risk-on sign of optimism. But at the same time, crypto was falling because huge institutions were pulling their money out, a classic risk-off signal of fear. So you've got two assets moving in the same direction, but telling us completely opposite stories. Bizarre. Now, for the market technicians out there, the dollar's drop was a huge deal. The DXY, which is the index that measures the dollar's strength, actually broke below a really important long-term technical level. For traders, this was a massive confirmation that yes, the market really believes a long period of dollar weakness is here to stay.
And then you look at the crypto side. My goodness. The selling pressure was just immense. This one number tells you everything you need to know. BlackRock's main Bitcoin ETF saw $2.7 billion in net outflows over the last 5 weeks. That is a gigantic structural headwind of big money selling that's just crushing any positive macro news.
Okay, so we've looked at the inflation report, the monster Netflix deal, the split in the stock market, and these really weird moves in the dollar and crypto. Let's try to bring it all home and figure out what these signals are actually telling us when we put them all together.
So, the main headline story of the day was overwhelmingly positive, right? A key inflation report came in cool, which basically guarantees a Fed rate cut. Markets loved that, pushing the big stocks up, and this huge Netflix deal shows the tech merger boom is kicking into high gear. But there's always a but, isn't there? And just like an iceberg, it feels like most of the real story was hidden just beneath the surface. That weakness in small-cap stocks, it points to credit problems brewing. The flat consumer spending, it shows people are still feeling the squeeze from inflation. The massive crypto outflows, that tells us that the big, smart money is actually getting defensive. And the dollar's breakdown confirms a major global currency shift is happening. The full picture is way more complex than the happy headlines.
So, all of this leaves us with the central, nagging question of the day. The big players on Wall Street are popping the champagne, celebrating the idea of cheaper money and higher stock prices. But are they completely ignoring all these warning signs, all these yellow flags that the real economy is sending up? That's the tension we're left with, and it's a big one.